What we want to focus on here, this is a thought experiment on how to think about rates of return, the short term versus the long term, taking into consideration factors like inflation and taxes. As advisors, we do focus on taking a more pragmatic approach versus over-allocating or allocating all of an entire portfolio into one particular asset segment. A question that has come up in the last few weeks related to interest rates being higher than we've seen in the last 20 years is, should I put more or all of my portfolio into short-term treasuries, for example, that are earning 5 to 5.5%? Let's do an exercise on the return that is earned on a bond that's held in a taxable account. Now, in the example I just mentioned, a bond, a one-year treasury bond, yields about 5.5%. If we buy a short-term bond that earns 5.5% over 1 year, we got to subtract the impact of taxes in a taxable account. 5.5% after taxes, say about 30% tax rate, means that bond is going to really earn about 4% after you pay taxes. Now extract from that the level of inflation, which is about 3.5%, and investors are left with about 0.5% return on that bond. That level may sound surprising and underwhelming, and it really kind of is, but however, that's the real return on experience on that bond investment. One important distinction when we look at nominal versus real returns is that no one ever really sees real return. You just feel it over time. Now, what I mean by that is that a nominal return is what we see on a statement. So what we see in a bank account, dollars going up or down in value. That's a nominal return. Now, contrast that with a real return. The real return is what we experience over the course of a year, for example, as spending needs or spending levels change due to the impacts of inflation. Same is true with taxation. We don't pay taxes on a daily basis. We tend to pay it at one point in time or periodically throughout the year. Now, the other question or thought that might come into someone's head is, if 5.5% is the guaranteed kind of risk-free rate right now, is that going to be better than what a diversified portfolio could deliver? The diversified portfolio has actually historically outpaced inflation and the level earned on short-term bonds. So to recap that, what we determined, what we observed from this research was that, number one, when interest rates are high, inflation also tends to be high. So your return is actually lower than what it looks like on the surface. And stocks and a diversified portfolio of stocks and bonds has actually outpaced inflation and short-term bond interest rates. We do like short-term bonds. We think short-term high-quality bonds are useful for a segment of the portfolio. Our view, though, is we need to be mindful as to how much we should own, because the key to growing wealth over the long term is owning assets that can protect in the short term from volatile stock markets, as well as helping outpace inflation. That, in our view, is the best way, the appropriate way to grow wealth.